Hello and welcome to the market update video. It's Scott Bennett and Mike Olafson. Mike, happy Friday. How you doing today, buddy?
I am well, Scott, and the market is having what I'd like to call looks like a digestion day after 3 days up, and a market score now 7. So definitely looking up, but cautiously optimistic. How are you doing?
I'm good. I guess the question is this guy with his finger on his temple of his forehead. What's he thinking?
Exactly. Exactly. That's exactly this video. What are we thinking about the market? What could it possibly do? So that's what this guy represents.
Awesome. We're going to go through that and a whole lot more. And before we do, world's quickest disclosure, this is just information, not a direct solicitation to go buy or sell anything. Please always do your due diligence, manage your risk. If you are need to look through all of that and then some, it's time to look at your financial plan. It's time to review your risk. We're here for you. Don't be stuck. I know the market's given a little bit of a bounce, but we want to make sure you always have a plan and you manage your risk. Stock market score. We have gone we've ticked up to a 7. So obviously this moves throughout the day. It's fluid. We have increased our exposure, which we'll talk about on this video, to 53.8%. We're managing our portfolio heat. The question of all questions is the US stock market, the S&P 500, is on a U-turn. The NASDAQ is on a U-turn. The small cap stocks are on a U-turn. International is on a gas signal. So you have this topping pattern that happened at the end of last year into the early start of this year. You had your fake breakout in February, and then the market fell apart really fast. And we did I would say we'll actually show you some stats, but we did an awful lot of protection at that time, falling about less than half of the market. So our process of managing big risk was there. You hit the trend line, and then you had official tariff information, and then it fell apart. You had your low in early April, and you had a secondary kind of like a higher low right here where I'm pointing, and you're at resistance and you're kind of teetering on it. My comments are you're probably, possibly, you've retraced if you kind of go from top to bottom, you've retraced about half, you're halfway back. This final gap has not been fully filled yet. Sometimes the market has a fun way of kind of going up, filling these gap areas where I'm pointing. So will it break up and out and go back all-time highs? Maybe there's clarity on tariffs, maybe there's less Doge, or will the market retest these lows? Right now, we're simply going to go with reality, which says short-term uptrend within a long-term downtrend, and we're going to look for gas signals, which are short-term and long-term uptrends, and we're going to be very cautious and manage our risk. So, Mike, I'll turn to you. What are you seeing?
This is a classic case of why I love trend following and what we do and letting the math kind of lead the way for us. Because when you step back and think about it, Scott, we could sit here and rattle off, just the two of us, we could rattle off at least 10 reasons why the market should continue to come down. Recession fears, inflation, stagflation, all that kind of good stuff. We could rattle off those reasons. I can't rattle off many reasons why the market would go up, but it still has been. And we're now at a score of 7. And so that's exactly why, even though I might have an opinion and a thought about what the market should be doing, the market's going to do what it's going to do. It doesn't care about my opinion or yours or anybody's. And so that's why this is interesting, where we're just going to go with the trend. We're going to be cautious. And that's why you don't see us full hog being, 80, 90, 100% invested. We're going to let the trend lead us. Scott, any other thoughts to that?
I would just step back and just simply say that if this market is going to fully recover and go to brand new highs, and we'll talk about timing and when that could potentially happen, but this is really early on. I mean,
Yes.
these moves can last a very long time on the upside. And the downside, we know it takes, people always say like the elevator or the trapdoor down. We just had
Yeah.
that. So very simply, we're going to go under the hood a little bit more and give a lot more perspective. So off to the far right over the past 14 days is where the strength is. Off to the far left is where the weakness is. So it's still telling you something that consumer staples is off to the far right. Utilities, which are coming back. International, this is where the gas signals are. There's a little gas signal, so meaning short-term, long-term uptrend in financials and communication services. So you had a good report or reaction from Google. You're going to get Meta next week. You're going to get a few others, but you have a lot of U-turns. It went from pink to greens and blues, which is really a good sign. Down below, I mean, again, Walmart, Tesla having a big day today. Obviously, Tesla's had a very awful year. And you have a bunch of financials still holding up. I mean, when they're going down lightly. But again, Meta has been under pressure. That's why we happily sold it for a profit. I think it was plus 20% before all the torture really started falling. And then you have ExxonMobil is struggling. So we're watching this closely. We're under the hood. I want to share a couple of just long-term perspectives and then macro thoughts. Again, this is a monthly chart that I clipped from TradingView, and you'll notice that we start here in the 2009, so like that 2008 global financial crisis. And I did two parallel lines, which catches the lows. It catches the low of COVID, and it also catches a couple other very big support areas. So we have just been in a glorious market where US large cap tech has been the leader. And very simply, why did we get so defensive? Because we broke this early area of support. You came down, you actually tested the support from the 2022 bear market. So you tested it here in 23 shortly, and you totally undercut it and you tested it. So I'm going to draw a very light blue line. This is where we're at. So hypothetically, could we chop around, maybe move sideways until we have a lot more clarity, which we'll talk about macro pieces. So could you kind of keep running up and out? But what if this thing does roll over? If it does, then here's where your support is, which is about negative anywhere between 15 to 25%, depending upon how fast you do when you get here. So will this be a recession? And if the answer is yes, and the market will obviously front run that even further, but this is where it will most likely get caught. So that's why we play with rules. That's why we play defense. Mike's, any thoughts on the underneath the hood or the monthly chart here?
Yeah, I love the monthly chart and kind of how you annotated it. And yeah, it really comes down to is this what we're going through the past week? Is this a sugar high that just folks are being optimistic and then reality sets in? We shall see. And but it is scary what you pointed out, Scott, that we could have potentially a 15 or 20% additional down leg should this chart kind of come to fruition on what you're laying out with the trend lines.
Yeah, and I think it's good to know your risk levels. So very simply, what are we doing today? We're still playing a lot of defense. So even though the score is at a 7 and we're kind of in the 50s, we have 46% yielding, higher yielding cash. The macro picture really hasn't changed. This could be the low for now. We'll play that as the cards as trend followers. What's working? We're lightly invested in the US. We have more foreign exposure, precious metals, Bitcoin, some defense, healthcare, staple stocks. We are diversified and we're still being cautious. But any thoughts, Mike, as we just want to work into trend following and what that looks like?
No, let's do it. I look forward to getting into some charts.
Yeah, Mike, why don't you go through this? So obviously, trend following is glorious in uptrends. It's very helpful in downtrends. Sideways markets, unfortunately, no one really wins. There's reversion to the mean type trading. There's selling into strength type trading. But the hard part is I would consider where we're at a bounce within a bear market as of this moment. But Mike, do you mind going over just kind of how we've done as a newsletter and just share our process and how it's been reflected?
Yeah, I'll just before we get into that dark color box in the middle, just to hit on something we've showed before that's really cool to keep in mind is that box to the far right, which basically talks about if you've got a certain drawdown, what percent do you need to get back? So that's why we really monitor drawdowns because it's important to understand where if you take a 10, 15% drawdown, it's a lot different from taking a 50% drawdown where you go down 50%, you've got to have a 100% return to get back up to break even. So with that in mind, let's talk about that dark box in the center, which basically is a summary of our strategy for the past 4 years. That also includes the S&P 500 as shown by SPY and the 60-40 bond mix as shown by AOR, the ticker AOR. And quite simply, what you've got is you'll see the CAGR first off, and this is from once again 22 to where we are today, the average compounded annual growth rate for our strategy is 7.4%, certainly which was higher, but 7.4%. The S&P 500 is at 4.6%, and AOR is dead flat. As people may recall, especially bond investors, back in 2022, the market got hit, but bonds also got hit too, which really took down AOR. Then the next line shows the cumulative return. But more importantly, if we go to the third line down, the max drawdown, that shows from peak to bottom the maximum that each strategy has drawn down a theoretical account, a model account. So for us, it's 12.3%. For the SPY, it's 25.1%. For AOR, 24%. So the key is, which would you rather do? Lose 12.3% in your account or 25.1? Clearly, 12.3 is basically less than half the drawdown of the general market as shown by the S&P 500. And then just to wrap this up and flip it back to you, Scott, I'll say what we do is we like to look at the risk-reward ratio. People call us a bunch of different things, but I like to simply say risk-reward ratio is your compound annual growth rate, your CAGR, divided by your max drawdown. And ideally, you want to see something that is, the higher the better. So 0.5, closer to 1 is always better. We're at a 0.6. And now to compare apples to apples, we do the same thing for SPY at a 0.2 and AOR at a 0. And that to me helps to understand the risk-adjusted return, where not only with the trend following strategy that we employ do you have a better growth rate, but you're also losing less on the drawdown because we have the ability to slip into cash, kind of like we are right now. Scott, anything? I put a lot out there, so anything you'd like to clarify or add?
Yeah, this is why we use rules. Let's take the most legendary buy and hold investor of history is Warren Buffett. Why is he selling down his Apple shares over the last several quarters? About, call it, I think it was 60 something percent. He sold his Apple shares down. Why does he have $344 billion in cash? He sees a very challenging, expensive market and a tough macro picture. That's why we use rules. We're just trying really hard to minimize a lot of the damage when the damage comes. And then when the coast is clear, we have a really sound system. But the question is can you manage risk during the tough times? That's where most people struggle. So if we can provide any help, signals, information to help you make quicker, better decisions, this is just simply a process. And we hope follow the trends, follow risk management rules. When the coast is clear, we'll follow big money. We'll show you a bunch of those slides right now coming up. So thank you again for being a member. Thank you for being on this journey with us. Do you have a plan? Thank you for being a self-directed investor. Reach out to us if you have any questions. hello@investwithrules.com. We care about you greatly. We want you to do extraordinarily well, minimize risk. And then when the times are better, which is most likely macro environment later this year, keep your powder ready. We will easily recover from any volatility and do extraordinarily well is the mission. Mike, any final words?
No, I can say is, and we do really mean it so sincerely. Thank you for being part of our small but mighty community. It's fantastic to have you part of it, and keep the questions coming. And we, have a great weekend. Forget about the market maybe for a day or two, and we'll see you back in the live shoot on Monday.
I hope this helped you kind of identify some either uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com. Thanks so much.